In this we are covering all the important questions, theory ones and numerical ones and case studies. Today we'll be starting with the case study, very important case study from module B. So follow the video till the end, share it with your friends, share it with all your social media platforms. Like the channel, subscribe to the channel. Subscribe to it first. Click on the bell icon. Okay. So let's start. First one. Here, this is a case study. PCR Bank has granted a term loan of rupees 2 crores to a reputed corporate client for 6 years at repo plus 2. So this bank has granted a term loan of 2 crores to a reputed client for 6 years at R plus 2, repo plus 2. So it's a floating rate. It is based on repo. So if repo is up, the rate will go up. If repo goes down, the rate will go down. So R plus 2 is known as the spread. The above said loan is funded by a bank with a low interest rate FD of 2 crores at 7%, whose maturity is 4 years. So the logic is very simple. On one hand we have loan, on one hand we have deposit. The deposit is the FD. Rate of interest is 7%, strictly 7%. So it is, this rate of interest becomes a fixed rate of interest, right? So look at this. This is the fixed rate of interest, fixed. Okay, and this is floating. So loan we have floating rate of interest, and deposit we have this fixed rate of interest. The loan is carrying a floating rate interest, as well as FD is carrying a fixed rate, right? Now based on this, you have to answer the questions. If the rate of interest is reduced on both loan and FD during the first 4 years, which type of risk the bank will be exposed to? Now look at this. Importantly, look at the fixed rate of interest, or FD. It is 7% for 4 years. Maturity is 4 years, and here the maturity is 6 years. So there is a problem in the maturity also. There is a difference in the maturity. Okay. So now once the FD is booked at 7%, later if the rate of interest goes down for the FD as well as the loans, in that case the present FD rate will not be affected. It will remain the same. The present FD which is going on, it will remain the same. So in this case what will happen? In this case, loan and FD, both the rates reduce. So even if it is reduces, then also my FD rate is 7%. Even if it reduces, what will happen for the next FD, new FD, it will be lesser. But for this FD, it will be same. So what is happening over here? This loan rate of interest is reducing because it's floating, repo. So this is reducing, but this fixed rate of interest, deposit rate of interest is not reducing. So which type of risk is this? In which the loan rate and the FD rate change in different proportions. So that risk is known as which risk? Funding, embedded, or basis risk. In the comment section, everyone, give me in the comment section. This risk is known as, yes, funding, embedded, or basis risk. It is basis risk, correct? Basis risk is a risk in which the rate of interest of the loan as well as the FD or deposit change in different proportions, different magnitudes. Okay. Second, rate of interest at the end of the 4 years may be different on the FD. So at the end of the 4 years, see this, FD is for how many years? 4 years. Look at this, fixed rate 7% at 4 years. So after 4 years, the rate of interest of FD will change. Which type of risk is this? Reinvestment, embedded option, or basis? Because after the 4 years, the rate of FD will be different, isn't it? Simple logic. Because the market will not be the same. So this is known as reinvestment risk. Okay, reinvestment risk. Okay. There's a possibility that company may prepay the loan or the depositor may withdraw the deposit prematurely. Which type of risk is this bank exposed to? Prepay the loan. Now this risk is always there in all the loans and deposits. Tomorrow the depositor can come to you and give back your deposit and take the money back, or close the loan by paying the full loan amount. So this type of risk is known as which risk? Reinvestment, embedded option, basis risk, or gap or mismatch risk. Which type of risk is this called as? It is embedded option. Okay, whenever the risk of pre-closure of any FD or if any loan is there, that risk is known as embedded option risk. With quarterly repayment of loan, the repayment amount has been deployed by the bank elsewhere at different rate of interest. Due to this, the bank is exposed to. So the repayment amount to be deployed by the bank elsewhere at different rate of interest. So bank, whatever the amount the bank is getting, the bank has invested that in some other investment option. Okay. Now due to this, the bank will be exposed to which type of risk? Means I am getting the EMI from you, and that EMI I am investing somewhere. So due to this, what type of risk will be there? Bank will be exposed to, yeah, it is, I'm investing in some other deposit somewhere or some other any instrument. Okay, so it will be mainly, yes, it is reinvestment risk because I am reinvesting that deposit. Okay, so I might not get that deposit at the same rate at which I am getting this EMI. Okay, so reinvestment risk. This was an important case study and you get it for 5 marks in the exam. So follow this again and again. Okay, let's follow some other questions, but before that, kindly subscribe to Officers Adda 24/7 English channel. Join the crash course and the new batch which is coming up, revision batches. Join it immediately. You can join the Mahapacks also. I'll show you how to join it. Okay, so let's move ahead with some other questions. Okay, and then I'll show you how to join it. The market risk arises on account of transactions reflecting in banking book, trading book, banking and trading book. So what is the answer over here? Banking book, trading book, banking and trading book. Banking book, trading book, off balance sheet exposures, anything. What do you think should be the answer over here? Market risk. Market risk arises because of trading book. Remember, trading book. Got it? When the rating of a financial instrument is lowered by the rating agency, the spread over the risk-free rate. Now what happened? This is a bit tricky one. Okay. Understand, there are two parts to this question. First is when the rating of the financial instrument is lowered. Okay. Now who are the rating agencies? Let's say simple. Let's take it CRISIL. CRISIL is a rating agency. Okay. Now imagine CRISIL, what does it do? It reduces or lowers the rating of this any company, let's say. Okay, let's say example, I'll say only X. Why to name anyone, isn't it? Let's say X company. So CRISIL reduces the spread this what rating of this X. Now the spread over the risk-free rate, will what will happen to this? Now if the rating is reduced, now you tell me. I'll ask you a simple question. See here, BFM is about understanding. Suppose if you are an investor and I'll tell you that, see, my rating has been reduced by CRISIL. Now you please give me the money. I'm issuing the bonds. What will you ask? What will you tell me? I was earlier giving the bonds when my rating was AAA. Let's say my rating was AAA, then I was giving the bonds at, let's say, 6% per year, per annum. Okay, I was issuing the bonds and you are taking it. Now my rating has been reduced to, let's say, B. Reduced. Now I again come to you, kindly buy my bonds. So what will you say? I'll buy a bonds, but the rate of interest required on this will be, now because your rating is reduced, I'll be requiring 9% now. This will be your requirement, right? You will ask me, right? You will ask me this. So this will be your asking rate. So what will happen? So if your base rate is, let's say, repo rate is, let's say it is 6%. So earlier that spread was what? 6 minus 6, 0. Spread was 0 over here. Now the rating has been reduced. So now 9 minus 6, your spread is increased. Spread equals to 3%, right? So it is increased. So what will be the answer over here then? Increases as the market demands higher yield on the higher risk on a higher risk instrument. Decreases as the market expects lower yield on the higher risk instrument. Remains constant, and there is no relationship. Now just now, as I gave you. See here, firstly, have you understood this? Because my rating is reduced, so people will demand from me the higher rate of interest, isn't it? So definitely as the rate of interest increases, my spread increases. What is the spread? Spread is the difference between the rate which you pay versus your base benchmark rate. So 6%. How do you calculate the spread in your normal savings account? Spread. How do you calculate the spread in normal banking account? Let's say any banks. We calculate the loan interest minus deposit interest, right? So if my loan interest is, let's say, 9%, deposit interest is, let's say, 6%, then what do I say? My spread is 3%. Okay, so this becomes my benchmark rate. Every spread there is a benchmark rate. Benchmark. In this case, in our case, what is given? This benchmark is the repo rate. So it can be anything. Huh? Benchmark means on which I base my further calculations. Got it? Clear? The process of market risk management has the following parts: risk identification, risk measurement, risk monitoring and control, risk mitigation, and risk pricing. So what all do they have? Market risk management. What will it have? Is it 1 to 5 all, or is it 1 to 4 only? Is it 1 to 5 all, or is it 1 to 4 only? Yeah. Oh, okay, I'll give you a hint over here. Now the answer is between B and A only. C and D are out, let's say. B and A. Either it's 1 to 5 all, risk identification, measurement, monitoring, mitigation, and pricing, or only 1 to 4. This pricing is not there. Type in the comment section. Let me see. This is a bit tricky one. Huh? Okay. So remember, shall I give you the answer? Yeah. It is this B. 1 to 4 only. Remember, market risk management. Market risk management. Okay. Market risk. What is the market risk? Market risk is that risk which is external to us. External. It is not in your hands. External to us. It is not in your hands. Okay. So that is market risk. Now, if this is the market risk, what have you to do? You have to manage it. Manage it means you can't zeroize it. You can never make this risk zero. So risk identification is a part, measurement, monitoring and mitigation, but pricing is separate. Pricing is always based on what is the level of my risk. So this is separate from the management part. Okay. So the answer is B, 1 to 4 only. That is the answer. 1 to 4 only. Got it? The market risk management policy formulated by the board of directors of a bank generally takes into account, means this market risk management. What did I say about market risk? It is external, not in your hands. There are three types of risks. What are the three types of risk? Credit, market and ops, right? At least in your the CAIIB you have these three types of risks and Basel 2. Okay, and if you consider Basel 3, then you have systemic risk as the next risk. Okay, so now this market risk management policy formulated by a board of directors. Here there is an important hint over here. Formulated by board of directors. Here any policy is formulated by board of directors. Now what are the parameters it takes into account? On what basis does this board decide? Market risk management policies, market risk management procedures, aggregate risk limits, risk review mechanism, and reporting and audit systems. What is the answer? Now many of you have got afraid that 1 to 5 may not be there, right? So the answer over here is A, 1 to 5 all. Okay, here the answer is all. Market risk management policies, the policies which are earlier decided by the bank. Now we are formulating a new policy, right? So here you are following market risk management new policy. So earlier policies, what did it say? Earlier history policies before this year. Procedures, what are the procedures followed in the bank? Limits. Now risk limits are of various types. Always remember, aggregate risk limits, there are various types. They are starting from the deal size limit to the per day limit to this per dealer limit to this aggregate risk limit. Review, risk review mechanism. So that is obviously the review should always be there, and reporting and auditing system. So all of the 5 will be taken into account. Okay. Which of the following is not a part of the role of the ALCO in a market risk management? Here, the 3 committees which are very important are, one is ALCO, then CRMC, then ORMC. These are the 3 committees which are very important. These are the executive level committees. Okay. More on these committees I have explained you in yesterday's lecture, I think so. Yesterday or day before yesterday. Follow that. ALCO, CRMC and ORMC. ALCO manages mainly market risk. Mainly. CRMC mainly manages credit risk. And its ORMC manages ops risk. Okay. So, which of the following is not a part of the role of the ALCO in market risk management? Think over it. What is the answer? Yeah. See, these types of questions are asked in exam. They are not that simple. Okay. What do you think should be the answer over here? See, let's see the options. Product pricing of deposits and advances. setting up guidelines for market risk management and reporting, funding policy and transfer pricing, and balance sheet management. Yeah. What do you think should be the answer over here? The answer is, shall I give you? See this, the answer is this, B. Setting guidelines for market risk management and reporting. Here, setting guidelines is not the part of ALCO. Okay. Now let me explain. I have explained you in earlier lectures also, but remember, the hierarchy is like this. First one is Board of Directors, BOD. Below this comes RMCB, Risk Management Committee to Board. RMCB, Risk Management Committee to Board. Below this comes Senior Executives Committee. Okay. Now this Senior Executives Committee is of three types. Okay. ALCO, CRMC, and ORMC. Below this, there is the group called as support group. Always remember, see, this is the overall hierarchy. Support group. Okay. Now one thing you remember, this is executives committee. So here their job is implementation. Implement. They are not there to prepare the guidelines. Guidelines are prepared over here. Preparing is done over here. Okay. So product pricing of this advances, we want not the job. Huh? So product pricing is the job of ALCO. Funding policy and transfer pricing, this is the main job of ALCO. Transfer pricing. Okay. Balance sheet management, this is also a job of ALCO. What is transfer pricing? Transfer pricing means the rate at which the loan is transferred within the departments. Tricky. Within the departments means what? It means that suppose if I am having let's say I am a retail department. Retail means I am having all the retail loans of housing loans. Okay. I am having the retail housing loans. Now I want to sell these loans to my treasury department. My treasury department. Okay. I want to sell these loans to my treasury department. So at what rate should I sell? So that is decided by the transfer pricing. Okay. And that is decided by the ALCO. Got it? Which of the following is not a correct statement regarding sensitivity in context of the market risk measurement? Sensitivity. Which of them is not a correct statement? Not. Okay. Now sensitivity. Now sensitivity is itself a big topic. Sensitivity measurement is itself a big topic again. Sensitivity is measured using this duration approach and BPV approach. This can't be explained over here right now. That's why I'm saying join the paid classes. New batch is starting. Join fast. Okay, I'll tell you at the end. So, sensitivity is measured at the as a change in the market value due to the unit change in the variable. We want not correct. Huh? Measured as a change in the market value due to the unit change in the variable. In the variable means generally it is repo rate, repo. It can be any benchmark rate, any. But this is a basic definition of sensitivity. Change in the market value of that bond or anything, any commodity based on the unit change in the benchmark rate. So this is true, but we want false. Sensitivity as a measure suffers from the fact that it does not consider impact of other parameters which may also change simultaneously. So is this B true? Think over it. Yeah. Remember, this sensitivity measurement is done using correlation. Correlation means this will always measure two factors at a time. Only two factors. Two factors at a time. Okay, so it will measure only two factors. That's why this statement is also correct. Suffers from the fact that it does not consider impact of other parameters, which may also change simultaneously. So these two factors only are considered. These two factors, let's say this example A only. Change in, let's say, the price of the bond versus the repo rate. So only two factors. It does not consider inflation. It does not consider any war-like situation happening. So these factors are not considered. So that is also true. Sensitivity as a measure suffers from the fact that it does not remain constant for all the values of the variable. Does not remain constant. That is also true. For all the values of the, as the variables change, the sensitivity will go on changing. Okay, you take the simple example of this duration only, modified duration. As the rate of interest goes on increasing, y goes on increasing, the modified duration goes on decreasing. See here, if the r goes on increasing, modified duration will go on decreasing. You must know the basics of this modified duration now. Okay, in this case, are you able to see this? Yeah, so modified duration will go on decreasing over here. Okay, so that's why this is also true. So what is the formula for modified duration? Modified duration equals to Macaulay's duration, Mac upon 1 plus r. Right? So as this r will go on increasing, this modified duration will go on decreasing. So the correct answer is D, none of the above, because we want a false answer. Okay, so the correct answer is D over here. Got it? So as told to you, how that I'll show you at the end how to join the batches. So this, go to Adda 24/7. Always go through the app. In the app you get 1% extra. Okay, so go to Adda 24/7. Click on JAIIB and CAIIB. Click on CAIIB November. See this crash course. Join this crash course. Okay, this one. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded sessions, everything you are getting. And at what cost? Click on buy now. Put the code Y432. Y432. Click on apply. See this 80% discount you are getting plus 1% extra using the app. So 81% discount you are getting. Join it immediately. Also, if you join the Mahapack, you are getting multiple double validity right now. Multiple batches you are getting 15 plus batches per subject plus double validity. Means you buy for 6 months, you get it for 12 months. You buy for 12 months, you get it for 24 months. Isn't it? So it's a great offer going on. Plus 80%, 81% off is there. Don't forget the code Y432. Okay? Join ASAP.